Everyone, to this week's session of the King's Crowd Investment Roundtable. We've got another great lineup for you in terms of some fantastic topics. So whether you are a startup investor or a founder who is raising capital in the online private markets, this is your data-driven, great place to check in each week to grab some good insights and hear what's going on in the industry. I'm joined by the two King's Crowd investment analysts, senior investment associates here, Léa and Teddy. Welcome to both of you. And I'm your host, Brian. We're going to be jumping into some great topics today, as I mentioned. We're going to be talking about the launch of the King's Crowd Data API in beta. We're going to then be going into this week's chart of the week, where we look at the top 5 pre-revenue companies that are raising online right now. We will then talk about WorldTree, one of the current offerings available on Dealmaker Securities, and talk about some of the nuances of fractional offerings and what that means. Let's jump into it. First thing we're going to start with today is the launch of the King's Crowd Data API. Now, as many of our viewers here and users of the King's Crowd platform are aware, we collect and have collected over 9,000 companies' private data on all of these companies, from audited financials to SEC filings to information about the team and all the other research and diligence that our team does. What we've done this week, actually over the past few weeks, is opened up for the first time ever this entire database where we collect 200 to 300 data points on every company and made it available through our API. We're very excited because this is going to enable the building and demonstration of new tools for investors in the industry. If anyone is interested in getting access to the API, feel free to contact us at help@kingscrowd.com, and we can help get you set up with a beta account. All right, that's the quick feature for the week, but now we're going to jump into the chart of the week. So Léa, take things away with this week's chart of the week, and I'll pull it up on our screen.
Yes, thank you, Brian. So today, we decided to look at the top 5 pre-revenue companies that are currently raising with the most capital raised before crowdfunding. Why did we do that? Well, as you may know, when you look at a company and try to figure out whether it's a good idea to invest in their current run, you want to look at a variety of metrics, such as the market that they operate in, the differentiation, and also their performance. But when it comes to companies that are pre-revenue, they can't really show a product market fit or traction yet. And so it might be interesting for investors to look at their ability to raise capital. That shows us 2 things. If a company has been able to raise a lot of capital in the past, first, it kind of gives you a stronger confidence because you think that because previous investors invested in the company, it may be a good deal. They're taking risk by investing in this company, and it kind of sends a good signal that says, if people believe in this, maybe I should take a look deeper at this deal, do my own due diligence, and see if I want to follow them and invest as well. The second thing is that a company's ability to raise capital in the past may indicate that they can raise more capital in the future. And this is very important if you're investing in pre-revenue companies, because if you don't know when they're going to generate revenue, they need to have an increasing amount of investment to survive. So when we look at the chart, we see that 4 out of the 5 companies that raised the most amount of money prior to their current crowdfunding rounds are actually medical companies. So Future Cardia, Pirate Medical, Spectrum Spine, and Ricard International. And what is very interesting is that they're not any pharma companies, they're medtech, so they have medical devices. Teddy, can you help us understand why is this important to look at how much a medtech company has been able to raise in the past, but what are also the other metrics that you should look at when you invest in these pre-revenue med companies?
Yeah, for sure. So it is quite unsurprising that 4 out of the 5 here are med techs, and then the last one, Starfighter Space, is like a deep tech, hard tech play. So these are obviously industries that require immense amounts of capital before getting to commercialization. So I think obviously the number one thing to look at when looking at these companies is, where did the capital come from, first of all? Like, are they VC investors? What are the quality of the VC investors? And then additionally, which I also think is very important, is if they have raised multiple rounds in the past, are the prior VCs also participating in the newest round? Like, are they impressed with the traction to the point where they're going to put more money pro rata into these deals? Um, so I think that's very important for companies in the equity crowdfunding space that you're analyzing that do have VC backed funding. However, I do think traditionally, from what I've seen in this space, is that medtech for sure, but also pharma, early stage pharma, which also requires a lot of capital. A lot of these companies are too early for venture capital investors or like the really high net worth angel investors, to the point where I think it is a blind spot for them. And there are a lot of opportunities out there if you do enough of your due diligence where you can get in on a lot of these early stage pharma and early stage med techs that don't have super bloated VC valuations. You can actually get in quite early and potentially participate in a large side of this upside before it's too late, when they are too far along and the valuations are much, much higher. So I think that's, it's both ways. Like if a company does have a lot of prior funding, that can obviously be a de-risking piece of it, but it also might be to the point where the valuation is like very high. So the upside could be more limited. So it's kind of a balancing act between those two, between, does it have a lot of VC funding, or if it doesn't, is that at a point where you can, really participate in the high upside? When you are evaluating early stage med tech, early stage pharma, you really want to see like what stage they're into in terms of, are they at animal trials? Do they have some human trial data? And that will usually determine whether there is VC investment, or if it's really early stage animal trials, they generally won't have VC investment, and that could be a really good opportunity to enter. So
quick questions. Yeah. So for both of you, when you're taking a look at these pre-revenue companies, do you look at a company's financials any differently when they're pre-revenue versus post-revenue, whether it's how they manage their burn, the cash on hand, especially when they've raised a lot of cash like this? Are there any questions or considerations that come to mind where you might look at things a little bit differently for these types of companies?
Obviously, more important with these companies than perhaps any other to manage burn effectively. And I think when you're really digging in to that, when you're due diligencing these companies, and when we talk to VC and when we talk to med tech and early stage pharma companies, it's like, exactly how much money are you going to need to get to the next stage of trials, where commercialization stage, or it's a stage where VCs would want to get involved. So it's really like they need to be so careful with their capital and have everything, at least in their 12-month budget, like very ironed out where it's going. So I agree, that's like more important than perhaps any other industries. It's like, how are they managing their burn, and how have they spent prior money, and have they hit any meaningful milestones from their prior amount raised? So
as an investor who is absolutely not trained to the medtech space, I also like to look at what are other people thinking about these companies. And I'm looking for institutional investors. I'm looking for networks of great advisors that have successful medtech companies in the space. I'm looking for accelerators. If we take the example of the two companies that are at the top of the chart, Future Cardia and Period Medical, which, for disclosure, are both of them King's Crowd Capital investments. I know that Future Cardia went into StartX and Johnson & Johnson accelerators, which shows that not only these accelerators kind of validate the potential of the founder and of the company, but also give them access to a wide network that may make it easier for them not only to raise capital, grow, develop their product, but also sell it. In the case of Period Medical, the company is backed by an impressive amount of famous venture capital firms, and the company also went into Y Combinator. Therefore, that shows us that there is also a lot of potential with this company, and we can be more confident if we're not sure about how the tech actually works. We're not sure about the market because we're not really in the space. That tells us, well, specialists in the startup and medical industry believe in this. So that's also a good indicator. It doesn't mean you have to jump and follow every company that goes into an accelerator or that has VC backing, but it's a good indicator that tells investors that you should take a look at this company.
I mean, we could do a whole podcast on medtech and pharma, but just like to really when you're diligencing these companies, like make the distinction between med tech and early stage pharma. Early stage pharma takes significantly more money to get through FDA trials. You need very large human clinical trials. You need a lot of safety and efficacy data in rodent models at first. Whereas with med tech, the majority of the ones you're going to see raising equity crowdfunding are going through what's called 510K clearance, which is basically all they need to prove is that their device is somewhat similar to a device that's already on the market today and already approved. And the timelines are just so much quicker. I think we've talked about this before, but I think it's worth hammering home that like 510K clearance is like a de-risked, if they actually have shown that they are close enough to predicate technology, it's like a big de-risking factor that I think is what I look for in medtech specifically. Whereas early stage pharma, it's a bit harder and it's more of like a long shot bet if you're just betting on some early stage rodent model data, which a lot of companies have.
Yeah, and I know Future Cardi and Pirouette both are taking advantage of 510K, if I remember, for that pathway. I'm not sure about the other ones on that top chart there, but definitely good reminder.
I've seen a lot of early stage pharmas like have very promising data for like curing very deadly diseases in mice. That is obviously a good first stage, but the example that I have seen is like we've cured cancer countless times in rodents. Like that has happened so many times, but seeing how that translates to humans is like a whole different ballgame and something that's very, very hard to predict and what makes early stage pharma significantly more risky, in my opinion, than medtech. So just something to keep in mind when you see companies touting that. It's obviously great, but it's not necessarily like automatically makes it a good investment.
Great. Well, let's move on to the next topic on our agenda. So WorldTree is a company that has done offerings numerous times on crowdfunding platforms. We wanted to talk about this investment opportunity, to educate everyone a little bit about WorldTree and the offering itself, but also talk about how some of these offerings that are being done are a little bit different. It's not necessarily an investment in the operating company itself, but you can structure investments through different series or fractional offerings. So to kick things off, Léa, why don't you tell us a little bit about WorldTree?
Yes, WorldTree is a company that is raising every year towards the end of the year, usually before or around Christmas time. And WorldTree is offering a very different investment opportunities. You're not invited by WorldTree to invest into the company, but into a batch of trees. So how does that actually work? When a company raises, at the end of the raise, they take the money that they raise on the ECF platforms and they will invest it in planting a new batch of trees. It's not WorldTree that directly plants the trees. It's farmers that partner with them. These farmers are located in various regions of the United States, North America, but also Central America, which kind of allows for mitigating the climate, environmental, regional risk. The farmers are going to plant the trees, take care of them for 8 to 12 years, so let's say 10 years. And at the end of these 10 years, they're going to cut the trees, and WorldTree is going to sell the harvest, timber being a high quality tree. At the end of these 10 years, whatever is the money that this batch of tree is generated, 50% will go to the farmers, 20% is going to WorldTree, and 30% will go back to the investors. WorldTree is promising to return to investors up to 4x the investment. So you're not looking at a 10x investment like you could have in a startup, but the risk is way lower. Basically, the risk is based on are the trees going to survive enough for you to get that 4x return. I want to say it's nearly impossible or very unlikely that a batch returns 0 or even 1x return, because that will mean that most of the trees have been decimated. If we look at the data from the past, since WorldTree has been doing that since 2016, the company has considerably increased its ability to save the trees and get most of the batch to go up to the 10 years. So in the first batches of trees, the survival rate are pretty low. they're around 30 each percent. But when we go up to the latest batches, which of course are only 2 to 3 years in, we have current survival rates around 90%. What that tells us is that there's a way higher chance today, if you invest in this current round in 2024, to have the batch you invested in reach about 75% survival rate than you had in 2016. However, if you invested in 2016, don't worry. It doesn't mean you're going to make less money if you invested right now. Actually, WorldTree increased its share price regularly year over year as it was making progress. So whatever the year you invest in, you can still target around a 4x return if everything goes well. So WorldTree is a very interesting fractional investment company where not only you're investing your money in trees to hope to get a return, but that also allows you to offset your carbon footprint. So there is definitely a climate impact in your investment. Actually, WorldTree is not the only fractional investment that is available on equity crowdfunding platforms. Brian, can you show us other examples of fractional offerings?
Absolutely. So when we talk about fractional offerings, what we're really talking about, right, are investments where the investment may be in a certain class of shares or in a certain asset or entity within the issuer who is giving the offering, but it might not be in the issuer itself. So an example, I'll just use an example of something that was out there that's out there right now. Finley is a platform that essentially lets anyone invest in athletes and kind of their future potential value of that contract. So you're taking a bet and putting an investment in someone who in the future may be able to make it to the NFL or the NBA or some of these major sports leagues. But at the time you make the investment, it's not yet a sure thing. And then they end up doing a revenue share to be able to give you a percentage of that athlete's revenues if and when they have contracts and sign contracts. Now, the way that that's actually structured, if you look at the SEC filings for this, is that they break them out into different series offerings so that Finlate, the company and the platform, is the issuer. But you can see that the first offering they did was in Ishedri Vargas here. That was actually closed or is going to be closing, but that's one active one. So that's one athlete. But then a completely different athlete that's being offered on Finley may not just be those early prospects. So Emmanuel Clase is actually a MLB player today, I believe led the league in saves, according to our source here. So you can find some actually very mature athletes as well as some of those early prospects. If you look at the offering for this, these investments that you make will be in a specific athlete. So you either invest in a Shedri or you invest in Emmanuel. Another example of this for another platform is Songvest. So Songvest is a platform that basically offers different opportunities to invest in songs, and you purchase fractional shares so that, again, if there's royalties or if that song becomes successful, you own and share in some of the future benefits of that. So if you take a look at some of the offerings that are live on Songvest, you can see that there can be a whole bunch of different offerings at the same time for different songs. So you can invest in certain deals at certain prices. Now, the way that if you go to the SEC, this looks is it's typically all going to be done actually under one or just a few offering circulars. So it may look like all the investments are in Songvest. However, because it's a fractional platform, what that actually means is that you're investing in each individual song through Songvest, and Songvest is the issuer. So it's a nuance and something to be aware of. There's a bunch of other examples of this. There is My Racehorse, which is a platform that allows investors to invest in different racehorses that has done various Reg CF offerings. There is also some other ones such as Compound. So Republic Compound were real estate offerings that would allow you to invest in different real estate deals, but it was all done under the same CIK in the SEC. So if you go to the Edgar database in the SEC for anyone who's kind of a power user, you can search by company or by ticker. And for example, if we pull up Songvest, we'll go, so Songvest Inc., this would be the company itself. This would be an investment in the company itself potentially, but then other ones, if you go to Songvest Records Inc., you can see some different Form C filings here. And if you pulled some of these up, that's where you will then see all of those different series LLCs that are structured. And that's basically a way for the platform to be able to give investors rights in very specific assets, but not the whole portfolio. So something to be aware of. It's definitely a nuance, but something that our users, we often get asked about. We have a lot of questions about it. So we wanted to make sure that we touched on it today.
A very important point to make regarding fractional offerings is that if you're an age user, you're going to realize that we do not rate these offerings. And the reason is very simple. Our algorithm, or equity crowdfunding rating algorithm, takes into consideration a couple of metrics such as performance, differentiation, market. Of course, if you take into consideration a batch of tree or a song, we just cannot really judge the performance of that song, these trees, because they're being launched or because we're talking about collectible. So that's why we do not rate these deals. And as an investor, you should look at them in a different way than if you were to invest in a potentially high growth startup.
I'm pretty new to analyzing the fractional side of things, but I think it's so cool that you can get in on an MLB All-Star like that. And I think as this space continues to grow, more and more really, really cool opportunities like this will come up. I also think it also goes into potentially things like portfolio diversification. If you're investing in World Tree in a batch of trees, that's a pretty steady known thing. The harvest will be within a certain range in however many years it takes. So it's almost like a rev share. It is a rev share type of deal that I think can be implemented into portfolio diversification in equity crowdfunding as a whole. When you don't need to look for the huge 10 to 100 Xers. You can kind of pad your portfolio with some more de-risk type of plays like this. And I think as fractional investing gets bigger, there'll be more and more interesting to consider for that.
There's been some YouTube offerings actually where you can basically invest in people creating YouTube channels and then share in potential success if they start generating revenues of the ad revenue or different sponsors. So we're really seeing equity crowdfunding, kind of this side of the market just being very innovative in terms of the different types of assets you can invest in. Anything that can be fractionalized, is going to probably eventually be fractionalized and sold.
So when I look at World Trade, I know the company tells me I have to wait 8 to 12 years before I get my return. If everything goes well, it should be somewhere between 1 and 4x. I know what to expect. But if I invest in a song and Songbest or an athlete, do you know what is going to be my return? Is there going to be a sell at some point? Am I getting any profit or salary part? Am I getting a share in the salary of the athletes or in the profits of the song? What if it's a song that already has been released and I come afterwards? Do we have any answers to the question, any clue on how do we get a return as an investor?
Great question. I would say and caveat any of this with, every deal is going to be unique. So you've got to, this is the importance of why you need to read that subscription agreement so that you can understand this. Because there's a couple different models. I think a lot of some of the ones we just talked about may tend to be more towards the revenue share side of things, where you may get X percent for Y number of years. So for example, for one of the athletes, perhaps you're getting, 15% share and you're going to get pro rata. So you obviously would not get 15% of a certain athlete, but if you invested 1% in that 15%, you would get a small percentage pro rata based on that for a set time period. Not saying that's a number for this, but for example, in addition, sometimes there may be liquidation clauses that do come along with that. So if it's, a song and maybe you're getting some royalties from that song as sort of, continuous dividend payments, but if that gets sold or acquired or, the license gets bought out, there may be provisions in some of these investment agreements as well. We use real estate as an example, right? It's something probably people can relate to. You may get rent payments, every so often. That's kind of a constant stream of dividends. But if that property then gets sold, you may also get a percentage of the equity value of that final sale value. Now, again, caveat, you need to read the deal terms. Every deal is going to be different. It may or may not include some provisions like that, but those are some of the things to look for. Well, we've covered a lot today. We went through the chart of the week, some of the pre-revenue companies with the most capital raised. We announced the launch of the King's Crowd API in beta, which has actually been out there for a couple weeks now, and lots of people are already using that. We discussed fractional offerings around World Tree and some of the different fractional offerings that investors will see. Thank you again for everyone for your time. If you want some more great data-driven insights, make sure you head over to kingscrowd.com. We also have a weekly newsletter where we put out these charts of the week and we go over some of the top staff picks and different deals that the team is looking at. That's Pitch Reviews, and you can sign up for that completely free newsletter at pitchreviews.com. Thank you again for joining us, and we'll see everyone next time.